Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I've got with us Scott from Sill and Reed Capital. We're going to talk about an inflationary recession, maybe,
Yes,
maybe not.
maybe.
Yeah. I mean, technically, I guess we've had two negative GDP quarters. I've read some stuff that, maybe this quarter will be not negative, it'll be positive, so it'll be turning up. But Scott, we were talking about this before about the differences between, we'll call it, the markets before and after the 2020 medical event. Before, a lot of things were driven by the housing market, the real estate market, and the business cycle. Those are the same cycles, and those cycles were driving the inflation and deflationary busts. But this time, as you pointed out, and I didn't point this out because I was looking at the housing starts. The housing starts are dropping dramatically. They've dropped dramatically. New house prices have come back down. And Scott made an obvious point that maybe I wasn't thinking about, because I'm still in the camp that we have a free market and that the business cycle, aka the real estate cycle, is going through these boom and bust cycles. So Scott, what did you bring up and what did you see and make a comment about this time being a little bit different than the previous cycles?
Yeah, sure. So I think going back to what it was like before, and if you watch I've watched Mike Maloney's Hidden Secrets of Money ages ago, but if you look at if you watch that video, he mentions, and correctly so, he talks about how over 90%, I don't exactly remember what the figure was, but maybe like something like 95% of the money in the system is created through loans. So commercial banks, basically commercial banks taking your deposits and loaning that out in multiple factors, creating new money in the system. So that's the fractional banking system that we knew of. However, I really do believe that it's changed. So the reason why I say that is because of the massive growth in the balance sheet of the Fed. And so what happened with the Fed when they created all this money is they directly injected this amount of money into the system through US Treasury, right? And so through the fiscal policies, and in particular during COVID. So this was mainly used to buy up your mortgage-backed securities and US Treasury and so on, but mainly to save the housing market, which made it go through to the housing market eventually, and through mortgages and so on. But then during COVID, what happened was this money was so Fed basically printed out the money, handed over to the US Treasuries, and then US Treasuries through certain social security type of programs, they handed out money, effectively doing helicopter money to the public. So the money that's been created through COVID didn't go through to the banking system. It went into the direct hands of the public. And so I think that's really different. And just to show you why it's so different, and this is what I should continue to show all the time, checkable deposits of households. If you actually look at the money that's been created, so this is, first of all, just to compare what the size of the household deposits look like right now. Let's first refer to the loans and leases in banking, in bank credit, or commercial loans. This is a total loan across commercial banks, and so you can see that the total loans right now, as we stand, is $11.5 trillion. So this is, well, up until now, I think pre-COVID, this was the main source of money creation in the system. However, what happened, I think, something that's not reflected in this figure, is this is the new money that's been created through the direct injection of funds into household deposit accounts through your COVID stimulus programs, through fiscal policies. And so now we've got something that looks like this. So your money creation, which typically came from new loan creation, this time around didn't come from new loan creation through the banking system, through the commercial banking system, using fractional reserve banking system, right? So now we've got all this money sitting in the checkable deposit accounts, and this is new money. And I think this is fundamentally different, because I think the money that the very readily available cash that's sitting in your deposit account is going to flow into different goods and services than how it would flow through the traditional commercial banking loan creation system. So I think it's very fundamentally different.
Yeah, and one thing that historically, just to kind of give everybody, this is at least an insight to what I'm thinking. Historically, what would happen is money would flow into the system. It would put everything into a supply shortage because you've got too much money chasing too many goods. It's the supply and demand of money. And when that supply demand of money put everything into a shortage, one of the most impacted things would be energy, because energy is the number one commodity and it's used everywhere. So energy, the demand for energy would go up. We would see oil prices go up. We'd see commodities go up. We'd see everything go up. And it was basically the transfer mechanism through oil was the transfer mechanism of inflation. But that was mainly driven by the real estate cycle and money coming into the system with new loans. With all of that money that came into the system, it again puts everything into a shortage. But this time, and I'm not going to use the words this time is different, but there are differences between this time and other times in history. We have supply chain shortages and we have an energy crisis. And the last time we had money coming into the system with an energy crisis was the 1970s, where America hit peak oil. This time, we've got the entire world pumping money into the system. We've got all this cash in the system, and we have an energy crisis worldwide, not just in America. So I'm looking at this, and the energy crisis is the transfer mechanism of all the money in the world being transferred into the consumer price index. Now, the consumer price index is what everyone measures inflation by. It's not the increase or the expansion of the money. They're measuring it by the increase of commodity prices and energy prices and house prices and all these other things. So if you've got the money in the system and you've got a problem in your energy system where it's going to transfer that money into the CPI, I think that paints the picture of a very inflationary problem by the way that everyone measures it, which is the consumer price index. Do you agree with that, Scott? Do you think that's the mechanism? Do you think that's where all the problems are going to be? Is the transfer mechanism and all that?
I think so. So basically, in short, what I'm trying to say is that historically, if you look at the traditional fractional reserve banking system, where most of money is created through banking loans, then it's obvious that asset prices rise, right? So your traditional real estate prices, your general equities where loans are made to, your businesses and things like that. But right now, we've got all this money sitting on the sideline, very readily spendable cash, which means I think it's going to be spent on more essential goods and services, something that people can purchase every day, such as food and energy. So I think we're going to see huge inflationary pressure, not in asset prices this time around, but in energy and food prices.
Now, here's a weird dynamic that I've been thinking of as well. And it's the dynamic of the money that came into the system is basically artificial. Years and years ago, 60s, 70s, 80s, 90s, all the way till, the 2020s, we had a free market that was basically determining how much money was coming into the system based off of the loans coming into the system. We've got this gigantic surge of money that came into the system. Now, here's my question. We've always had interest rates fluctuate with the supply, demand, and that loans coming into the system based off of real estate. We have a large injection of money all kind of at the same time, which is very inflationary. And that inflation could potentially put interest rates at a spot that the market normally wouldn't put it because of the inflationary pressures from an artificial injection. Could it be possible that the housing market comes under pressure in the short term because of the amount of money that they created and the interest rates chasing that amount of money with inflation, going to a quote abnormal level that we wouldn't see in relationship to the buying of supply and demand of housing? So it could bring the housing market back down because the level that the interest rates must get to in order to, we'll call it tampen or dampen this inflation, is above and beyond what the housing market would normally set it. Does that make sense?
That
Do you
makes
think
perfect
that's
sense. I think that's 100% right. So right now the Fed is using obviously the interest rate as a tool to control inflation, but I think you're seeing disparity in the inflation rate between the asset prices and food and energy prices, for example, right? So obviously energy prices, if you compare the rate of increase in housing prices versus energy prices have gone up a lot more at a much faster rate, right? Since the medical event.
Mhm.
And so the Fed is trying to catch this energy price increase, and it's more structural and more fundamentally driven by supply and demand than the money creation alone. Obviously, money creation has a very large impact on how much inflation we see, but this energy crisis is more structural, right? So you're seeing energy crisis in Europe, you're seeing it in other countries, and they're trying to tackle what could be a combination of both money creation. Obviously, we're seeing a lot of money, but velocity of money hasn't picked up yet to drive the inflation, right? So money creation probably contributed a lot to it, but I think it's the fundamentals that are really driving energy prices. But what the Fed is trying to do is tackle the inflation that we're seeing from the structural fundamental supply and demand picture for energy with interest rates, which means I think they are somewhat destroying the natural market, interest rate market for your real estate. So yeah, I think we could see them really slow down in the short to medium term.
slow down real estate, right?
Real estate, yes.
Yeah. Yeah, because I've been thinking about this. If energy is that short and we have that much of a problem, the real estate market could slow down and it won't actually impact inflation the way that they measure it through the consumer price index, which then puts us in what I call it an inflationary recession or stagflation.
Yes.
That's what it would be. We would see a recession in the normal market or slowdown, and then we would see in the inflation being driven through energy prices and the energy crisis that we have worldwide. So looking at this worldwide, how do we solve the energy crisis? What I mean, that's really, if this is the biggest thing that we have to tackle, how do we make money from it? I mean, that's basically the channel, right? Where's the value and what do we need to solve? And I think, obviously I'm a big energy bull. Do you think there's other plays outside of oil, natural gas, uranium, energy service companies? We've talked about that a lot. Do you think food's going to be a good opportunity? Do you think there's a lot of things that could happen there, or
Yes. I think so. I think food's going to be an excellent opportunity as well. But I mean, I think energy will probably play out first, because if you just think about it logically from a time sequencing point of view, it's going to be energy first because we're in desperate need of energy. And the lack of farming activities this year and lack of utilization of fertilizers because of the Ukraine-Russian conflict and so on are going to come later, because obviously the farming, once you farm, until the time you actually sow the seeds and you harvest, it takes a period of time. So until the food crisis really picks in, I think it's going to take some time. Whereas energy problem is like right here, right now. And come winter, like who knows what's going to happen to European countries, right? So I think energy is more imminent than food crisis, but I think after energy, food could be the next one, next big thing. So yeah.
Of any of the markets that you follow, what do you think has the highest probability of going up of any of the markets?
Of any of the markets?
Yep. Highest probability, not the biggest risk reward, but the highest probability of success.
I think uranium.
Uranium?
I
And
think uranium.
Why do you think uranium? Why is that the highest probability of success?
So uranium, everyone is literally turning to nuclear. And it's very visible through, I guess, the amount of energy generated through nuclear power. And I can show you this where, I mean, for example, China. And this is where I think it's the highest probability, because I'll tell you why. So with natural gas, we know that there's a small risk. I mean, nothing comes out without risk, right? Nothing comes without risk. But if you look at China, one of the biggest, well, the biggest users of electricity since 1993, when they introduced nuclear power, like their nuclear power generation has just gone up vertically, and we know they are trying to accelerate this. And we know that a lot of the countries, say for example Germany, who has turned off their nuclear power, and also Japan, that's turned off nuclear power, are restarting their nuclear fleets. So you've got Japan that was sitting at these levels, Germany that's been coming down. They are potentially accelerating, which I think will create huge demand for nuclear energy, and it's very visible on the chart. And we're drawing down on inventories. We've already drawn down on a lot of inventories through Sprott Physical Uranium Trust, for example. And I think the transition to nuclear energy is only going to accelerate from here, and the demand supply gap will only accelerate. And I think, I mean, I was thinking about this the other day actually. The certainty of place. So if you're talking about any commodities, any mining companies, whether it be oil and gas companies or whether it be gold companies or whatever, you are effectively reliant. I know with uranium, we've talked about the lack of cash flow in a lot of the companies, but I think if you think about it logically, and if you think about the mining companies, the oil and gas companies, we are ultimately reliant on commodity prices going up. Because say, for example, if oil prices fell, then oil companies could very quickly become losers, right? Especially the high cost producers. So they might have very positive cash flow now, but that could turn on a dime if the commodity prices were to fall. So effectively, what I was thinking was we are ultimately betting on the commodity prices, right?
Yes.
So,
yep.
And so I think in terms of the commodity price, uranium is by far the cheapest. And we've done this stuff. I think we've done a video a couple of months ago where we said, uranium versus everything else. And uranium had to basically outperform all other commodities by a factor of 5 if it was to repeat the valuation of uranium highs back in the 2000s. So it's very much undervalued. There's a huge transition to nuclear power. It's inevitable. We've got a huge supply deficit right now as we stand. We've drawn down a lot of uranium existing inventories. And so I think uranium is, for me, the surest bet.
Yeah. So I always look at the international pricing of natural gas, then I look at the Henry Hub and I say, these have to converge. So that's where my head's always at. But yeah, from a risk reward standpoint, I mean, even natural gas is still good, but uranium is pretty dang good. So obviously I'm in all of these investments. That's for sure. And if anyone's interested, platinum membership below, I'll throw my plug in there. I share all those picks. You can see my portfolio and you can see what I own. But yeah, I think
they've done fantastic so far, I must say. Your picks have been unbelievable.
yeah, I've got some decent picks, and there's still some that are still down in some other sectors and in uranium that I think are really good buys, in my opinion, that I'm buying at least. But yeah, so uranium and natural gas are my top two as well right now. And I do like oil as well. And, I didn't jump on the coal train. I missed that one, I guess. But I put it all in natural gas and oil and uranium for the most part. And I still have the precious metals and stuff like that. So what else do you think's a very good spot to be? Precious metals?
I like precious metals, but I think I like shipping a lot. And we've talked about this very briefly. I like shipping a lot right now. I think with shipping, the ships just turned around. Ships just turned around in that everyone's starting to turn into profit, right? So all the dry bulk shipping companies, for example, they've just turned into profit. And if you compare the valuations of shipping companies now to what it was back in 2000, by any measure, it is so dirt cheap. I know there's a risk of deglobalization. I know we've talked about the risk of nationalization. But if you look at the shipping companies, for example, dry bulk shipping companies. Let me just pull this up because I just want to highlight what they are mostly made of, right? Oops. So this is dry bulk demand by your the materials that they carry. So iron ore, as you can see, is like the biggest part of it. You've got other thing, coal, which is also a big part of it. And they are really, if you think about it, they make up for the majority of the dry bulk shipping demand.
Mhm.
I don't know if so obviously iron ore, obviously the biggest consumer of iron ore is China. Biggest consumer importer of coal is also China. So everything really depends on China. But China, I think, is going down right now. I know they've got like problems with real estate and things like that right now. You know, things are having difficult times, but I think they are just starting their expansionary fiscal and monetary policy, because we've just heard that PBOC, so Bank of China, has just announced a cut in interest rate while everyone else is raising their rates. And PBOC, I think, basically said we need fiscal stimulus too on top of this. So I think they are headed towards that. And we're going to see exactly the repeat of 2000s, which was what drove the iron ore prices to sky high levels, and also the BDI prices to sky high levels, which is they're going to start, I think, an infrastructure program pretty soon. I mean, I don't know exactly when, but I know they are right now in a position to start the expansionary fiscal and monetary policy, which I think will be good for your iron ores, good for coal, good for, you know, everything else that they import. Because if you look at coal, let me just share with you iron ore imports, right? This is what's crazy. So iron ore imports by country.
Yeah, there you go.
China midgets everyone else. Iron ore imports by country. So this is obviously the biggest. China 3.6 billion. So 70% of total imported iron ore, right? And the rest of the world is Japan, South Korea, Germany, and so on. But this is your biggest component. So as long as China maintains an expansionary fiscal policy, I don't see how iron ore does, how dry bulk shipping, for example, does badly over this commodity boom. And I think the way in which that China is selling down on US treasuries, and also looking to stockpile, because that is the primary way in which China's a lot of the sovereign funds, as well as a lot of the manufacturing companies in China, will try and manage the risk by stockpiling stuff that won't exist in the future. So I think that could bring forward the demand in the short to medium term. And I think that could drive the dry bulk index, Baltic dry index, a little bit higher, or maybe a lot higher in the short to medium term. They're my thoughts. Is there a risk? I think so, because obviously there's that China-Taiwan conflict right now, and we've talked about potential sanctions on China as well. But do I really see that as a risk? I mean, obviously, Australia is one of the, where I reside, Australia is one of the biggest producers of iron ore. I don't know how Australia sticks with the sanctions to China, because that means Australians are pretty much entirely reliant on the Chinese economy. If we cut out our trade with China, this is what I think will happen. If we did, if for some reason our politicians decided that it's a good idea to cut trade with China, I think our Aussie dollar, we're gonna have a currency crisis. I think our currency, because if you think about it, your currency is only as desirable as the exports, as your exports, right? Because if no one wants to buy our services and goods and services, then your currency suddenly becomes not desirable at all. The only thing that's sustaining our currency and why we see Aussie dollars rise during a commodity boom is because of the commodities that we sell, because that's the biggest component of our export. So if we were to cut ties with China and said, we're not going to export any iron ore, obviously China is like our biggest customer by far. I don't know. We're going to be destroying our currency to start off with. We're going to create chaos in our economy. And if we want to, I mean, we sell way more stuff to China than we do to the US. So I don't know. Like, can politicians make such silly decisions? Yes. Is it likely? I don't think so.
Right, right. So you like shipping quite a bit. That's what
I
I
do.
what I gather there. Do you like it more than uranium?
I
Mm,
honestly think some of the shipping names could outperform uranium names. And the reason why I say that is if I look at the shipping company valuations, I don't know if I can pull it up quickly enough, but I was looking through a couple of names in the past couple of weeks to see how they performed in 2000s. And if you look at the PE ratios, I know everyone talks about shipping companies as if they should be trading at NAV, right? Net asset
mhm.
value.
Yep.
I mean, I think it's naive to think that, right? Basically, because what you're saying is it doesn't matter what the PE ratio is, right? The shipping company should be trading at, net asset value. Because, I mean, the thing is with shipping companies right now that are trading at 2 times, 3 times earnings, or even one in some cases. I mean, if you imagine a company that you can buy for 1 PE, it means you're gonna get your entire capital in through
Right.
earnings and cash flow in 1 year.
Yep.
It just doesn't make any sense right now, the valuations. And so I said, okay, this is not right that shipping companies need to trade at NAV, right? So I looked through a couple of names back in the 2000s, and basically it's same with most of the commodities companies, most of the miners during their peak of the commodities market. Right now, a lot of the natural gas companies are trading at like 3 times earnings, 4 times earnings, 5 times earnings as well, like ridiculously low valuations. And if you look at the shipping companies and natural gas companies back in the 2000s, at their peak, a lot of them are trading at 10 to 25 times PE, right? 10 to 25 times PE. And that's when you know you're near the peak, I think, in terms of the cash generating mining companies or shipping companies. And a lot of the dry bulk shipping companies in the 2000s, with a net income of 100 million, they were trading at a market cap of 1.8 billion.
Mhm.
Now I know we've talked about Castor Maritime, and this is not a recommendation to buy the stock or anything. We know we talked about Castor. Castor now generates annualized return, net income of 100 million, yet trades at 160 million market cap. So to repeat the valuations, so it's the same income, yet in 2007 or 8, these companies are trading at 1.8 billion, yet Castor is trading at 150 or 60 million right now. So it needs to do 10x just to catch up to its PE multiples of the 2000s. So even if we didn't see any earnings increase, if we were to repeat the valuation of 2000s, we need to just do 10x. So how about if BDI went up 10 times? And we also had the multiplier effect of PE. That means some of these companies, not saying it will or it won't, some of these companies, if they were
Good.
to repeat the Baltic Dry Index, the increase in Baltic Dry Index that we saw in 2000s, as well as the PE multiples, we could be looking at 100 to 200 baggers on some of these things. We
Yeah.
could,
Yep.
if
The
these
math.
things happen.
The math works
It,
out.
and
Yep.
and also the nonsense of net asset value, that they need to be trading in that asset value. I mean, if you look at a lot of the tanker companies right now, which have gone up quite a bit, a lot of them are trading at like 5 times the net asset value right now. And if you look at the dry bulk shipping companies back in 2000s, they were also trading at 5 times NAVs, 6 times
Mhm.
NAVs. So I mean, and some of these Baltic dry bulk shipping companies right now is trading at like 1/5 their net asset value. Like, I mean, for me, I mean, and to catch up to the net asset value, right? Of to the 2000s, that means it needs to do 25x without seeing a value increase in the ships, right? So in the vessels. And vessels, most of them are recorded at a much lower rate because obviously they recorded when at the purchase value minus depreciation. Much lower rate now than they did in 2000s, because in 2000s, if you look at the balance sheet back then, they were buying all the new ships. Like they were ordering it because obviously, the Baltic Dry Index did well, and they were ordering more ships. And these ships were valued at like 50 to 80 million dollars per ship. Whereas right now, if you look at the balance sheets, these ships are only recorded at what, 15 million per ship
Right.
per vessel.
Mhm.
So I feel like shipping companies I really like right now. I really like shipping companies, and I think I probably like them as maybe almost equal to uranium companies right now.
I know I was talking to you earlier and you kept talking about shipping, 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 shipping. I'm like, oh, he really likes the shipping companies. I mean, I own shipping companies too. It's an okay size of my portfolio, but well, it's not huge, but you know, it's there. I feel like I have enough exposure. So that's good. That's
Yeah.
good.
But you were saying
Um,
that you were saying you've kind of changed your views on dry bulk though. You wanna maybe talk to the audience on that? Or have I changed your mind after showing you all these
well, I
stats?
mean, I the only thing that I'm afraid about with dry bulk is I think that there could be nationalization that occurs, and that's going to happen with an energy shortage or a commodity shortage. So when people or countries when countries start to see how short these materials are, they'll say, I don't want to ship this, I don't want to send it out, let's just keep it for ourselves. And then that could, you know, snowball or domino kind of into more people or more countries saying, we don't want to ship our energy, we don't want to ship this, we don't want to ship this, and then everything's kind of just cut off. That's kind of the only concern that I have or risk. Not saying that that's necessarily going to happen, but I just think that if commodities, let's just say that we are at the end game of commodities and energy. Like let's say that we are tapping the world, what the world can give in terms of flow rates of some of these commodities. Not all of them, but some of them. I just don't know what, you know, what's going to happen after. I don't know if people are going to get scared and just hoard it or whatnot. I don't know that next, like what their actions would be, because we've never seen this happen before. We're going,
I know.
this is the problem that I think um we've got a bunch of people, I think they call it like linear thinking, where they just think like whatever is going to happen before is going to happen next. I think at some point that's going to change dramatically, and I think the world's going to just look different and change. I don't
Yeah.
think we can go back to, you know, sitting on our computer clicking buy and it just shows up at our front step and everything's in stock and it's all good. I just think that at some point, and I don't know when that point is, I feel like it's gonna change, and I don't know what the trigger point will be. We may have already entered and hit the trigger point, which is that some countries like Russia do not want to sell their commodities priced in dollars. And as they transition away from that, I think other countries will transition away from that. And then I think that some countries will be less willing to accept fiat paper currencies for the hard work and the energy that it took to get the commodities out of the ground. I think that whole thing will collapse. Then I don't know, like as that occurs, I just don't know what happens next. Like what's the next domino to fall, or what's the next trigger point? I'm just worried about that. And you know, if you invest in, you know, there's some pretty good things that you can look at. I'm a big Canadian natural gas oil bull because I think they're going to be one of the last countries to be able to export this stuff. And then everywhere else, I think it's going to get pretty tight. I don't know how much America can export. I don't know how much, you know, the Middle East, as more internal demand grows, they're able to export less.
Yeah.
So I think over time, if you look at all this stuff, the wealth is going to be transferred to the oil producing countries, but that wealth is also their downfall because they're able to export less of the very thing that's making them wealthy. So I just think the world's going to get squeezed on exports at some point. I just don't know the exact timing. I don't know what this is going to necessarily look like, but I'm trying to figure it out.
Yeah. So I
So
agree with that. I agree with a lot of things that you've said. But I think dry bulk is I think we've got the right commodities in dry bulk that will make sure that we don't really stop trading. And I'll show you why. You
iron
know that
ore, coal.
Australia is Yeah, you know that Australia is one of the biggest producers of iron ore, right?
Yep.
And so if you look at so in cases where you've got nothing to gain, let's say like your relationship is more like China and the US, where US just sends you notes like your US dollars and China gives all the goods and services away. That's a losing trade for China because you're only getting paper money in return for the goods and services that you actually send to the US.
Yep.
Whereas I think the trade relationship between Australia and China is a lot healthier in that we still export a significant amount from China. So Australian imports by country, $72.86 billion, right? So that's a significant amount for Australia to import from China over any other countries out there. Like from United States, we only import 26.61 billion, for example, right?
Mm-hmm.
So we do get a lot of goods and services in return for the iron ore and the commodities that we send. So basically, we send the commodities, they send us finished products. It is the relationship between Australia and China. So Australian exports by country, China is by far the biggest export country for Australia, right? So will this trade relationship end where both parties benefit from the trade? So we send the commodities, China benefits from the commodities, we import from China the finished goods and products, and we also benefit because we actually see goods and services on our shelves of our supermarkets or wherever it might be. So I think it's a mutually beneficial relationship between China and Australia that I don't think the iron ore trade, for example, and the coal trade, because we export a lot of coal to China as well, which form the biggest components of Baltic Dry Index. I don't think that trade is going to stop. And I don't think there is any reason why we should hold on to our commodities because we've got no use for them. What are we going to do with all the iron ore, right?
The only thing that I'll say there is that all of these are priced at the margin, though. They're priced at that last ship or the last few ships that everyone's fighting for. So I think a small change in the dynamics could have a large impact on price. So I do understand that. And it's just like that for any commodity. You get down to we'll call it, it's good. And then your inventories hit a certain level. And then it's just like, moonshot. So
that's right.
that's where my worries are, is that something happens somewhere in the world that starts a domino effect. And then remember, these things get all priced kind of at the margin. So
it could. Yep. And that's the risk with all commodities, right?
Yep.
I mean, I think that risk is real for anything. So, I mean, for example, you've got uranium, the risk is obviously a nuclear accident. If that was to happen, then that could very quickly cut demand for uranium. With natural gas, if somehow Russia resolves conflict with Ukraine and they start supplying natural gas to European regions as per usual, then natural gas is at risk. Same with everything else, I think. So I think, as you always say, Andy, spread your bets.
Yes,
that's what I'm.
Whatever's a large asymmetric bet, I usually have a little bit of money in there. Yep.
Yes, exactly.
So what else? Do you have anything else, Scott, that you'd like to talk about?
No, I don't think so.
Yeah, I think we covered quite a bit here. So if you guys want to reach out and contact Scott, you've got the Twitter information at @U_AG_. And then you can also visit his website, YouTube website, Sow and Reap Capital. They also create videos, and you can watch videos there as well. So thanks for coming on, Scott. Anything else you want to share? I know you like. There we go. There we go.
So, I know I've shared this a couple of times, but I mean, this is, I think, fundamental to my Christian life, which is be joyful always. Pray continually, give thanks in all circumstances, for this is God's will for you in Jesus Christ. So God wants us to be happy. God wants us to be joyful. God wants to talk to us continually. So just wanted to share that.
All right, guys. We'll catch you next time. This is Finding Value, and Scott, thanks for viewing.
See you, everyone.